If you're like me, then you do not enjoy spending every moment thinking about money, how much you can get, what's the best way to save every last penny. However, it is the modern world, and we need to make smart financial decisions. With the cost of housing being what it is, having a basic understanding of how mortgages work can make a huge difference. On its face, mortgages are fairly simple to understand. You borrow money and then you pay interest on the balance, kind of like a credit card, but there are a few things that make it a little different. By the way, for the pedantic among us, in this series of videos, I'll break it down into simple segments that anyone can understand and reveal how and why some of the advice you hear on the internet can actually work. Let's start by discussing the interest rate and payments. The first term that you need to understand is the compounding period. And all that means is how often is the interest applied to the balance of the loan. Let's say you took out a $100,000 loan for 7% annual interest. That $100,000 times the 7% interest would equal $7,000 of interest for the first year. In this case, you would have a compounding period of 1 year. Pretty straightforward, right? However, even though we mostly talk about mortgage interest rates in annual terms, that's not how interest is usually applied. Normally, you have to make a monthly payment on your home loan, and the lender applies an interest charge to your balance every month. However, if you applied that 7% interest rate every month, the amount you spend on interest would be astronomical. So how does it work then? To have your 7% interest rate compound monthly, you simply take the 7% and divide it by the 12 months in a year, and that becomes your monthly interest rate. Here's how the math actually works. If you look at your monthly compounding period, each month you would be charged this amount on your balance of $100,000. If you add those 12 months of interest together, you'll see that lo and behold, it's the same as your annual compounding amount. In order for this to be true, you would only pay the interest each month. However, we don't only pay the interest on our mortgage balances. We pay a little more, and that difference is applied to the principal. The principal is essentially the balance on your loan pre-interest. The amount that you owe goes down slowly over time. Spreading the payments out like this is called amortization. And this is one of the interesting things about how a mortgage is calculated. Some brainiacs figured out this fancy equation which calculates how much each payment needs to be for a given balance, interest rate, and number of payments. So one can use this math to figure out what a payment would need to be to bring you to a zero balance after 360 months, or 30 years. What this means is that every month you pay the exact same amount. We'll go into different lengths of loans in another video. This is what it looks like when shown on what we call an amortization table. You can see how your early mortgage payments are going almost entirely to interest. As you pay the balance down over the course of the loan, that switches to paying more principal than interest. At a 7% annual interest rate, you pay equal amounts principal and interest at about year 20. Here's what that looks like on a graph. And this is one of the reasons why some people advise making larger payments up front, because any amount above the calculated payment goes directly to principal, reducing not only the balance on your loan, but it can also produce huge savings of interest down the line, depending on how long you own your home. If you liked this video or found it helpful, be sure to like, subscribe, follow, share, all that stuff, so that you can catch the other videos we will be rolling out in this series. We'll be looking at some different topics and scenarios that I know my clients have found useful over the years. Thanks for watching.